Well, Woodside right now is in the midst of a storm. Recently, climate change protesters, egged on by the ABC's Four Corners, have protested outside its chief executive, Meg O'Neill's home. And the Maritime Union and Australia's Workers' Union threatened a strike on the North West Shelf. That sent global gas prices sharply higher in the past week. That market is so delicately poised with, of course, no Russian gas going to Europe after the Ukraine war. For the half year, Woodside's underlying profit was $1.89 billion. That's up 4%. Taxes and royalties it paid were $3.65 billion. Today, I caught up with the Woodside chief executive and asked her if the company and the world is being held to ransom by those workers threatening to strike.
Ross, let me speak to 2 points. First off, the global energy markets. I think what we've seen in how the prices have reacted, particularly in Europe, to the rumour of potential industrial action, for me is a signal that the global energy markets are very fragile. We saw that last year, following Russia's invasion of Ukraine, where global energy trade flows were completely disrupted. Oil trade flows, gas trade flows. Europe was desperate. They turned coal back on. They started importing LNG in record quantities. Financially very positive year for us, but the market was highly disrupted. I think what we've seen in that price response is the fact that the market is still quite fragile and Europe is very worried.
So your workers, the Maritime Union, the AWU, they're not ignorant. They recognise that fragility of the market. Are they exploiting that with their action or their threatened action?
So let me get to the crux of the discussions. So we've been in enterprise bargaining with our workforce since earlier this year, since about April. We've had a number of meetings that have been very constructive, where we've been able to really talk directly with our workers, understand what's on their mind, understand what's gotten us to this point. We've been able to resolve a number of items. We've taken the approach that we need to approach this very constructively. This is a workforce that we've had a relationship with for many, many years. It's a workforce we're going to have a relationship with for many years as we go forward. It's got to be one that remains respectful and constructive throughout. And I feel good about the progress we're making. And we'll continue to have those discussions.
So should the federal government intervene to make certain that there is no outbreak of inflation caused by rising energy prices around the world because of some Australian workers, your Australian workers? Is it a case where they should be talking to the Energy Minister, they should be talking to the Industrial Relations Minister to make certain that these workers continue to do their jobs and continue to make certain that there is no disruption to international energy prices?
Look, I note that protected industrial action can take many forms, and the list of possible protected industrial actions that the workforce has supported is wide-ranging. And it ranges from things that I would describe as inefficiencies, frustrations, slowdown in doing business, where the bulk of the energy would continue to flow, to more extreme stoppages. We really don't know what the union's going to do. Look, I'm sure that customers are expressing their areas of concern to the government, as they have on other market interventions that have happened. But all we can do is continue to have that really constructive engagement with our workforce with the goal of landing an enterprise agreement that both parties are comfortable with.
Okay, so then take me to the federal government and the PRRT, the Petroleum Resource Rent Tax, and the increase in that. The government says it wants to get more money up front rather than having years of getting no tax revenue simply because of the enormous cost of building the infrastructure for these oil and gas sort of fields in the first place. Is that a disincentive for you to invest in Australia in these fields?
So when we make investment decisions, one of the things that is most important to us is fiscal and regulatory certainty. The confidence that if we make a decision today, that in 10, 20, 30 years' time, we will have more or less the same fiscal terms. So that said, any change to the regime is concerning. I would note on this specific change, though, that the Callaghan review on PRRT was conducted many years ago. A number of adjustments were made immediately following the review, and there was a couple of matters that were left open. So as the industry, we've said that, look, this isn't exactly our preferred outcome, but reluctantly, if this is an outcome that is better for the Australian people and gives us certainty for the next decade, then that's an outcome that at least gives us confidence about some of the future investment decisions we're going to make.
Because it's your partners, your customers in South Korea in Japan, potentially in China, that really do, if you like, bear the brunt of this, because they feel as though the terms that they signed up with to invest tens of billions of dollars have been betrayed by the Australian government.
Look, I don't think any investor in the sector is particularly happy about paying more taxes. But again, if we can have certainty for the long term, then that's not a bad outcome.
Do you think you've got certainty for the long term? Because one change today could lead to another change tomorrow.
Yeah, look, we need to see what the legislation holds. You know, what had been described was a certain change today and confidence for a 10-year period, but we need to see what the legislation holds.
You're a global top 10 oil and gas producer in the world. You have choices to where you invest. Your key assets are on the northwest shelf of Australia, but you can invest in the Gulf of Mexico, you can invest in other parts of the world. Is really Australia got to be careful about the settings it has so it doesn't drive that investment, the jobs, the tens of billions of dollars in investment away from this country?
Look, as you know, we are a global company. Following our merger with BHP's petroleum business, we've got a very attractive position in North America. We've got a number of assets that are producing on the U.S. side of the Gulf of Mexico. And one of the assets that came to us is a field called Trion, deepwater oil field on the Mexican side of the border.
Which you've just given final approval
Which we have
for.
just given, we have just taken our final investment decision on that. So very significant investment.
And what sort of money is that?
So 7.2 billion US on a 100% basis. Our share is just shy of 5.
Are there similar fields in other parts of the world that you could have put that money into?
You know, there's not a lot of undeveloped fields of that quality remaining. So when we acquired that asset in the merger, we took a look at it. We really pushed the team hard to make sure that we had a high quality development plan, that we had confidence in our contractors and our ability to execute, particularly given the volatility we saw in the market last year. But at the end of the day, it's a high quality investment. It's going to deliver value to our shareholders over the long term. So yeah, we're super excited about Trion.
Okay, just a final one for you. Are you concerned about the deflation in China, the slowdown in its economy? Does that bring a bearing, a weight on oil and gas prices over the next 12 to 18 months?
Yeah, so China's economic health does have a significant impact on the global economy, and particularly as it comes to energy demand. What's been really interesting this year, though, is watching the prices, and the prices have stayed pretty attractive, actually. We've seen a few things. So OPEC has deliberately curtailed supply. A couple of key players, Saudi Arabia has taken some incremental cuts to try to keep the price in a band that they find attractive. What's really interesting on the gas side is the gas market continues to be quite strong. Obviously not at the heady heights of last year, but we continue to see quite strong pricing for LNG, and China is taking more LNG this year than they did last year. So even though their economy is not bounced back the way some might have hoped, they still are using quite an amount of energy.
Meg O'Neill, always good to chat to you. Many thanks for your time today.
Thank you, Ross.